Silver experienced a shocking 35% plunge within just one trading day. This was not spread across days or weeks but happened all at once. The date was March 19, 2026. It stands as the most dramatic single-day collapse in silver history. Meanwhile, gold suffered its roughest week in over a decade, dropping around 10% overall. A staggering $7 trillion in market value simply vanished into thin air. If you hold precious metals and have been tracking discussions here on oil dynamics, Federal Reserve actions, and inflation signals suggesting stronger gold values, you probably saw long-accumulated profits disappear in what seemed like the blink of an eye. I can already guess the question running through your mind right now. You are probably wondering why I had been so confident about gold heading higher. You recall me emphasizing that the underlying structural reasons looked rock solid. So what on earth just occurred? Let me explain clearly what unfolded. This kind of sharp drop was never something to avoid entirely. In reality, it was almost inevitable. History shows it has occurred during every major gold bull market in modern times without fail. There is one particular 29-minute period on March 19 that clearly demonstrates this event had zero connection to any real change in gold itself. From 9:01 in the morning until 9:30, nearly all buying interest evaporated from the gold order book. Once you grasp exactly what took place during those critical minutes and the reasons behind it, your entire perspective on this drop will shift dramatically. I am Alex, and over the past 10 years I have dedicated myself to studying commodity cycles, central bank activities, and Federal Reserve decisions so that you can focus on other things. If you are tired of knee-jerk reactions to scary headlines and instead want real insight into what is truly driving precious metals markets, then please subscribe to the channel and give this discussion a like, because the ideas here carry more weight than usual. Before diving deeper, I would love to hear from you directly. Did you end up selling amid the panic? Or did you choose to buy more or simply stay steady with your holdings? Please share honestly in the comment section below. I am curious to understand the current sentiment among everyone here, since today I plan to walk through a repeating three-phase cycle that appears consistently across every gold bull market in recent decades. The first phase involves a strong upward move. The second brings a sharp correction. The third reveals what follows afterward. I will detail precisely how the third phase has played out each time after the second phase correction occurred. For those who sold during last week's turmoil, the coming explanation may feel particularly challenging. We have now stepped into that second phase. Yet the smart investors who grasp this recurring process are staying calm and even using the moment to build positions strategically. So let us examine the real events of March 19 in detail. If you observed the price movements and immediately assumed the gold bull market had run its course, you have the story completely reversed. The market action revealed nothing meaningful about gold fundamentals. Instead, it exposed serious issues in market mechanics and liquidity flows. Picture this scenario for a moment. A fire alarm suddenly blares inside a packed movie theater, causing everyone to rush desperately toward the exits. The resulting chaos does not indicate the film itself was poor quality. It simply means the exit doors could not handle the sudden surge of people all trying to leave simultaneously. Something very similar struck the precious metals markets on March 19. Three separate pressures converged at the same time, and importantly, none of them related to any weakening in gold intrinsic worth. The first pressure came from a rapidly strengthening US dollar. When crude oil prices surge aggressively past $100 per barrel, global investors begin anticipating higher inflation, persistent elevated interest rates, and greater dollar strength. Because gold trades worldwide in dollar terms, this dollar rally exerts automatic downward force on gold prices. It is not that gold suddenly lost appeal, but rather that the same physical ounce now requires fewer dollars to purchase due to basic currency conversion mathematics. The dollar index, known as DXY, pushed decisively above the key 100 mark on that day, triggering widespread automated selling pressure across all precious metals contracts. Reports from Financial Contents Market Minute highlighted that the latest producer price index reading came in 0.7% above forecasts, which further propelled the dollar higher past that important level. The second pressure involved a chain reaction of margin calls. This part becomes particularly painful to review. In the lead-up to the drop, silver had climbed an impressive 278%, moving from $30.82 all the way to $161 within only 12 months. Gold itself advanced 96%, reaching $5,400. Such rapid gains attracted heavy participation from leveraged traders, creating overcrowded positions. The CME Group had already increased margin requirements for silver futures on 3 separate occasions as a precautionary measure. The first adjustment occurred in January when silver approached $120, followed by another hike on February 6, raising requirements from 15% to 18%. They recognized the growing leverage risks and attempted to ease tensions gradually. However, the simultaneous spike in oil prices and dollar strength caused the situation to explode regardless. Many overextended traders faced margin demands not primarily on their precious metals holdings but across their broader portfolios, including stocks, energy, and currency positions. When everything turns against you at once, the quickest source of cash is often selling your best-performing assets. In this case, that meant unloading gold and silver holdings. The motivation behind the sales had little to do with doubting gold's long-term outlook. It was driven purely by the need for immediate liquidity and survival. Traders were forced to liquidate winners simply to offset losses elsewhere. It amounted to urgent cash raising under intense pressure. The third pressure deserves your closest attention because it directly ties into that notable 29-minute interval. This involved amplification through algorithmic trading systems. During the window from 9:01 a.m. to 9:30 a.m. on March 19, the gold order book saw its liquidity depth collapse by 98%. Take a moment to absorb that figure. Almost all buying support disappeared suddenly. This did not occur because market participants suddenly lost faith in gold. Rather, the automated systems responsible for providing ongoing liquidity, including market makers and high-frequency traders, simultaneously withdrew their offers upon detecting the wave of selling pressure. Return to the crowded theater image once more. Now envision the exit doors themselves narrowing even further while the crowd continues pushing forward desperately. That illustrates the impact of algorithmic liquidity being removed from a stressed market. Kirsten H. Hotner, who leads commodities research at Vontobel, characterized the event as a textbook deleveraging episode in which overly extended speculative bets were compelled to unwind from an already crowded momentum play as stop losses and margin requirements triggered throughout the system. Analyst Olanson from Saxo Bank described it similarly as a standard correction within an overcrowded trade, while noting a crucial observation that underlying fundamentals showed no alteration whatsoever during those 29 minutes, yet virtually no counterbalancing buyers appeared. The heavy selling pressure drove gold prices down through $4,800 and toward $4,557. This movement did not represent any fresh assessment of gold's true value. It reflected the market infrastructure itself straining and temporarily failing under overwhelming strain. The alarm sounded loudly, the exits became blocked, yet the theater building was never actually threatened by fire. What sets the March 19 event apart from previous corrections and possibly makes it even more encouraging for the longer term is that while the triggering mechanism mirrored 1980, the underlying demand picture stands in complete contrast. This key distinction alters expectations for the path ahead significantly. Back in January 1980, silver reached a peak near $49.45. At that point, the COMEX exchange took an unusual step by limiting activity strictly to liquidation trades only. Participants could sell silver contracts but were prohibited from opening new long positions. Consider how that would feel if a major stock exchange suddenly declared that Apple shares could only be sold going forward with no buying allowed. The inevitable outcome would be a steep price decline. Silver subsequently fell 78% down to $10.80 in what history remembers as Silver Thursday. The core process resembles today closely, with margin pressures forcing positions to close rather than any shift in actual supply-demand balance. Yet the vital distinction between 2026 and 1980 demands careful consideration. In 1980, demand proved largely artificial in nature. The famous Hunt brothers had employed leveraged futures to attempt controlling the silver market. Their buying interest existed mainly on paper, supported almost entirely through debt. Once exchange rules shifted, that paper-based demand evaporated quickly since little genuine underlying need existed. No major industries relied heavily on that silver supply at the time. It remained pure speculative activity. By contrast, demand in 2026 rests on solid structural foundations. Manufacturers of solar panels require silver for each photovoltaic component they assemble. Producers of electric vehicle batteries depend on silver for critical electrical connections that lack easy substitutes. Data centers powering artificial intelligence applications consume massive electricity and need silver throughout their server infrastructure for reliable connections. Additionally, central banks continue acquiring gold at a steady rate of approximately 190 tons each quarter, according to World Gold Council data, marking an unprecedented pace historically. One simple statement captures the fundamental separation between this correction and past ones. No one can issue a margin call against an operating solar panel production facility. I will revisit that idea shortly, since it holds the clue to why the upcoming third phase may deliver even greater upside than previous cycles. First, though, let me highlight a pattern that should capture your full attention. We have now witnessed 4 distinct corrections that adhere to the identical 3-phase sequence. The central question therefore becomes what consistently followed in the third phase after each second phase drop. Anyone who exited positions last week may find the historical answer somewhat unsettling. Recall March 2020, when the COVID crisis disrupted global markets. Gold declined about 12% across 2 weeks. This had nothing to do with pandemics being negative for gold. In fact, the opposite holds true. The drop occurred because widespread margin calls forced investors to liquidate their most easily tradable and profitable holdings to cover losses in plunging stocks, bonds, and other assets. That represented the classic second phase. Does this sound recognizable? It should, because the underlying mechanics match exactly what occurred on March 19, 2026. The catalyst differed, yet the liquidity breakdown followed the same pattern. Subsequently, the Federal Reserve unleashed unlimited quantitative easing support. Real yields plunged deeply into negative territory. Gold then advanced roughly 40% during the following 6 months, establishing fresh record levels. That marked the third phase recovery. Moving to September 2011, gold attained a high near $1923 before retreating 20% over 3 months. Margin calls stemming from the European sovereign debt concerns affected all asset classes, prompting sales of gold simply because it offered liquidity and had previously performed well. It served as the convenient source for raising urgent cash, representing another second phase. Importantly, the core structural supports for gold, including ongoing central bank purchases, currency weakening trends, and sovereign reserve diversification, remained completely intact. Gold eventually surpassed previous peaks once more, entering the third phase. Then in February 2022, following the Russian invasion of Ukraine, gold initially jumped on geopolitical tensions before experiencing a sharp sell-off as conflict-related market swings generated margin pressures across portfolios. Again, this was second phase behavior. Later, as real yields moderated, gold climbed back to new highs, delivering the third phase. Across these 4 examples, the mechanics stayed consistent, and recoveries that exceeded earlier highs occurred every single time within the contemporary gold market cycle. The recurring sequence begins with a geopolitical or crisis event sparking an initial gold price increase. Margin requirements then compel forced selling. Gold experiences a sharp decline as market plumbing strains. Eventually, real yield dynamics reassert dominance. Genuine structural buying interest surpasses the temporary paper market liquidation, allowing gold to rebound and achieve higher levels. Participants who recognize this cycle tend to accumulate during the second phase. Those lacking awareness often sell in panic at the lows, thereby missing the subsequent third phase gains entirely. Stay engaged with me because this next section brings all the elements into clear focus. So far we have reviewed established historical patterns which indicate likely possibilities. Now I want to demonstrate why the fundamental case supporting gold today appears even more robust than when major banks like JP Morgan established their price forecasts. This assessment holds even prior to recent escalations involving Iran before Qatar liquefied natural gas disruption affected worldwide energy supplies and ahead of the Federal Reserve maintaining a hawkish stance during their March 18 meeting. The real concern should not center on the correction itself since that stemmed from technical factors. Focus instead on elements that showed no meaningful change. Naeem Elam, Chief Investment Officer at Z Capital Markets, expressed it succinctly. Recent inflation figures did not shift abruptly. Market expectations around policy did not reverse suddenly. What broke down was the belief that traditionally defensive assets would continue offering reliable liquidity when markets faced stress. Consider that point carefully again. The issue was not with gold itself. The failure occurred within liquidity provision. The paper trading arena suffered a temporary seizure while the real-world structural backdrop continued unchanged. Let me outline the 4 key supporting factors that sustained gold around the $5,400 level and invite you to evaluate whether any weakened during the recent volatility. First, consider the persistent silver market supply shortfall. Data from the Silver Institute 2025 World Silver Survey indicates the silver sector has recorded deficits for 5 straight years. Global consumption exceeds mine production annually, with the imbalance growing as demand from solar energy, electric vehicles, and data centers accelerates. That shortfall showed no sign of reversal on March 19. Second, examine central bank purchasing behavior. The World Gold Council reports ongoing quarterly gold acquisitions by central banks averaging 190 tons. Sovereign governments are methodically reducing reliance on dollar-based reserves, with active buyers including China, India, Poland, Singapore, and Turkey. A brief disruption in paper trading does not alter long-term national strategies. Central bank gold accumulation represents a multi-decade shift in geopolitical reserve management. It persists regardless of short-term algorithmic withdrawals lasting mere minutes. Third, assess the current Federal Reserve position, often described as frozen in place. Just 1 day prior to the correction on March 18, the Fed maintained its target rate between 3.5 and 3.75%. Policymakers find themselves constrained, facing stubborn inflation on one side and a slowing economy vulnerable to recession on the other. Raising rates further risks economic damage, while cutting them could reignite price pressures. This policy standoff creates an ideal setting for gold because it ensures real yields calculated as nominal rates minus inflation remain low or negative for the foreseeable period. Negative real yields rank among the strongest historical catalysts for rising gold prices. This situation existed before the correction and continues afterward. Fourth factor involves sustained oil prices above $100 per barrel. Higher energy costs push inflation expectations upward faster than nominal interest rates can adjust. When inflation outpaces the returns available on cash or bonds, real purchasing power declines steadily. In such conditions, gold serves not merely as a store of value but as one of the most practical assets capable of protecting wealth over time. None of these 4 foundational supports showed cracks during the recent market event. Not a single one. Here is a candid observation that may resonate strongly. The correction did not expose weaknesses in the overall gold investment rationale. Instead, it highlighted shortcomings in common approaches to holding gold. Traders relying on leveraged paper futures contracts faced significant losses. That outcome reflects leverage risks rather than any problem with gold. Leverage tends to amplify downturns eventually, as history repeatedly demonstrates. Speculative short-term options positions also suffered. Stop-loss orders placed at obvious technical points were triggered efficiently by trading algorithms as intended. However, if your approach involves physical metal ownership, long-term unleveraged positions, and recognition that gold functions as a monetary asset amid ongoing currency value erosion, then March 19 altered nothing fundamental for you. Analysis from golds.com illustrated this contrast vividly. Premiums for physical gold actually increased during the sell-off period. While automated systems dumped paper contracts, real buyers entered at discounted levels, understanding the disconnect between electronic pricing and actual metal availability. The widening spread between paper quotes and physical market conditions sends a clear message about participant motivations. Return to the earlier statement that solar panel factories cannot receive margin calls. This concept unifies the entire discussion. During 1980, removing leverage caused demand to evaporate because that demand originated from leverage itself. The silver accumulated by the Hunt brothers served no practical industrial purpose at scale. In 2026, however, removing excess leverage left genuine demand intact since it stems from expanding industrial needs that grow steadily each year. Solar project timelines do not halt due to temporary gold price weakness. Electric vehicle assembly operations continue unaffected by a one-day silver decline. Construction of artificial intelligence infrastructure proceeds without pause despite brief disorder in COMEX trading activity. Speculative capital momentum-driven participants who joined simply because prices trended upward were effectively removed from the market. This outcome serves a useful purpose. It represents the natural function of the second phase, which eliminates less committed holders. This creates opportunities for serious capital, including sovereign funds, industrial users, and dedicated long-term investors to enter at more attractive valuations ahead of the third phase. When these various threads are woven together, the overall picture becomes difficult to ignore. J.P. Morgan established their fourth quarter 2026 gold price objective at $55 per ounce well before recent developments including heightened Iran tensions, the Qatar energy supply interruption, and the Federal Reserve signal of continued caution on March 18. None of those factors have been resolved favorably. Each one continues to provide structural tailwinds for gold prices. The fundamental support structure remains fully in place and arguably strengthened beyond the level at which that J.P. Morgan forecast was issued. Current gold trading between $4,600 and $4,800 alongside a cautious Federal Reserve multi-year silver deficit, central bank purchases at 190 tons quarterly, and oil exceeding $100 does not signal the conclusion of a bull market. It more closely resembles a period of consolidation and energy building before the subsequent advance. Recall the theater comparison introduced earlier. The alarm-activated exits became congested. Participants experienced discomfort during the rush, yet no actual danger existed within the building. Presently, the space has cleared somewhat, allowing the genuine long-term participants to settle comfortably while the primary performance remains ahead. Every comparable episode from 2020, 2011, 2022, and the 1980 silver parallel reinforces the identical lesson. Second phase corrections do not terminate bull markets. They function as the renewal process that prepares bull markets for their next expansion stage. Returning to the initial observations, you witnessed silver decline 35% in one session and gold record its weakest weekly performance in 15 years. During those 29 minutes on March 19, it appeared momentarily as though the entire precious metals outlook was unraveling. With the details now clarified, you can see that the apparent collapse stemmed from liquidity dynamics rather than any erosion in gold value. The buyers did not withdraw due to diminished conviction about gold prospects. Their absence resulted from trading systems reducing support amid a liquidity strain event unrelated to gold merits and tied instead to stressed financial system operations. That brief window represented not destruction but a necessary resetting process. It mirrors the clearing action that preceded the 40% gold advance following 2020. Similar dynamics set the stage for record highs after the 2011 correction. The same pattern unfolded ahead of new peaks following 2022. The second phase embodies periods of heightened uncertainty and emotional pressure. The third phase offers the environment where lasting value creation occurs. The critical difference between experiencing fear or capturing opportunity lies in comprehending these market mechanisms rather than allowing them to dictate your decisions. Imagine your perspective 5 years from now looking back on March 2026. That future version of yourself is observing the choices you make in the present moment. The structural arguments supporting precious metals have endured. The key supporting factors remain solid. The historical pattern continues unbroken. The essential decision concerns whether you will position yourself advantageously as the third phase commences. Considering gold, silver, Federal Reserve policy, oil prices, central bank strategies, and margin dynamics, what particular aspect would you like explored more thoroughly next? Share your suggestions in the comments. Gaining clarity on these topics has become increasingly important. It determines whether you react instinctively to alarms by rushing toward exits or recognize the absence of real danger and secure an advantageous position for the unfolding story.